Right, it's 10:30. Good morning, shareholders, and welcome to the Plato Income Maximiser Financial Year 2020 year-end results. My name is Chris Mayer. I'm the Director of Listed Funds at Pinnacle Investment Management. Pinnacle is a shareholder in Plato Asset Management, the manager of the company. We'll refer a lot today to the company as PL8 by its ASX ticker. So in case you hear us refer to PL8, you know what we're talking about. Pinnacle handles all the marketing and distribution for PL8, including shareholder engagement. I will be your host today. Joining us today is Dr. Don Hampson. He's busy redecorating the boardroom there, I can see. Don will be no stranger to many of you. He's a director of the company and also the managing director of Plato Asset Management. Today, Don will give you a presentation. He'll cover the company's results, which we announced last week for the financial year, and he'll also give Plato's view on the dividend outlook, particularly why Plato feels like they can still generate superior income from dividends, despite the fact that dividends are being cut in certain parts of the market. At the end of Don's presentation, we'll do a short Q&A session. If you would like to ask a question and you're unfamiliar with Zoom, please use the Q&A button should be at the bottom of your screen. You just click on that button and you can type a question into that Q&A box. You can do so at any time during the presentation. Finally, Don has the slides in front of you, as you can probably see. For those of you who aren't looking at the video but are dialed in, you can also find the presentation on the ASX under PL8 or on the company's website. I'll now hand over to Dr. Don to run us through the presentation. Don, if you wouldn't mind, please referring to the slide numbers so that the listeners can follow along. Thank you. Over to you, Don.
Okay, well, welcome shareholders, and good morning, everyone. Hope you are all well and are doing well with the funny world that we're in at the moment. Today we're going to review the annual results, and as Chris said, we'll have time for questions at the end. It's been a very interesting sort of last 12 months. Interesting means tough, I suppose. Hopefully you've all had time to read the disclaimer. We'll now move on to the agenda itself. We'll take you through the investment strategy and performance. Also do a bit of a market update, including looking at the most recent reporting series, which is most relevant, I think, for looking forward to what we can expect during the rest of this pandemic. And as Chris said, we'll have time for questions at the end. So moving into investment strategy and performance, clearly FY2020 was negatively impacted by COVID in the last 4 or 5 months of the year. But if we take if we compare it to last year, it was chalk and cheese, because if you, it's a long time ago now, but if you think back to the presentation we did this time last year, we're actually talking about FY19 being a dividend bonanza. We saw an extraordinary level of dividends being released by companies sort of 18 months ago or so, because of a number of things, but largely because of the fear of a potential franking credit change, which was an ALP policy at the time, and that has now gone away, thankfully. But what it did mean is that a large number of companies paid out special dividends or increased ordinary dividends, or indeed there are a number of companies such as BHP Rio that paid out very large buybacks when they sold assets and did it in a tax-effective way. So there's a huge amount of dividends released and franking credits, and that meant that our earnings in 2019 were extraordinarily high. And now we come to 2020, we see our investment income's actually fallen by a third, even though the company is actually larger than it was because of an issue of new shares. But that really reflected us rolling forward from the ALP franking credit policy period, but also then having in the last excuse me, 6 months, the impact of COVID. So income fell by a third. Net profit fell a little more than that by 38% to 21.5 million. And earnings per share fell a bit even more so because we did have a share issue in the September quarter last year, which is in this financial year just gone by. So our earnings per share fell to 5.3 cents per share. In terms of dividends, we actually paid out slightly more than what we received during the year. We paid out 5.7 cents ordinary dividends, fully franked, and no special this year. That was a 5% fall from last year on ordinary dividends, but there was also no special. And as you're probably aware as investors, that directors did take the decision that the impact of COVID would be to reduce dividends that the company will receive, and accordingly, the directors determined to modestly reduce the monthly dividend that was paid from April this year to 0.4 cents. That's a 20% reduction, but that's less than what we expect the market dividends to fall. We're actually expecting market dividends to probably fall by 30% or more. So at the moment, the company is taken a cautious approach and moved fairly early, but we believe that it's important for investors to continue to receive a monthly dividend. So moving into the details now in terms of investment performance, it was a very negative half year. The market actually fell, and this includes franking credits, so it's a total return including franking credits. The ASX S&P 200 index fell 10% in the half year and 6.6% over the full 12 months due to the impact of COVID negatively impacting share prices. The portfolio performed much better than that, so we actually only fell 8.5%, but we were 1.5% ahead of the benchmark in the second half and 0.8% ahead of the benchmark over the year, and that's an after-fee number. And from inception, we are now 0.3% above index since inception. And that's on an annualized basis. So we have outperformed the index, which is one of the objectives of PL8, as well as delivered higher income along the way. Whilst the company's only been going for a few years, the longer-term investment performance of the underlying investment portfolio, remembering that PL8 actually invests into an existing unlisted share fund, the Plato Australian Shares Income Fund, and you can see the sort of nearing 10-year track record of that Plato fund there. And I think pleasingly, although you probably can't see it because of my photograph there, but we actually performed or outperformed the market on the way down in March this year, but we also have slightly outperformed as the market rebounded in sort of April, May and June. So it's quite pleasing that we have had some pretty good performance this year relative to the index. It's not that pleasing that the index itself is down, but the market has rallied a bit more as we've moved into this current financial year. In terms of realised yield, the market yield did fall. So the cash yield of the market in financial year 2020 was, by our calculations, 3.5% cash dividend yield, a further 1.2% franking credit yield. So the market delivered about 4.7% gross yield in financial year 2020. That's a bit over 1% lower than normal due to the impact of COVID. At the same time, the company delivered 7.4% gross yield, a 5.2 cash and 2.2 franking. So we did deliver or distribute more income than the market over the course of the year. In terms of the dividends, the company has paid consistent monthly dividends since inception. You can see there for the last 3 months, or you might be able to see it, we did reduce that dividend by 20%, but the company is still paying regular monthly fully franked dividends. And we are, in fact, the only Australian listed investment company that does pay monthly fully franked dividends. That is certainly an aim or an objective of the company. In terms of the NTA performance, clearly with the market falling and the company continuing to pay out regular dividends, you can see that the capital value of the portfolio fell during the year. We also paid out dividends, and there's a small negative from company expenses. So the NTA did fall quite a bit over the course of the year, but that is to be expected in a negative year. But we have seen it increase a little as we've moved into this financial year. Pleasingly though, if you look at how the company has traded relative to NTA, apart from a few small periods, the company has largely traded above NTA over the last financial year and continues to actually trade a little above NTA even today. So that is, I say, very pleasing, because we know that the average LIC out there is actually trading at a discount. So we think it reflects the strong income and regular income that PL8 is able to deliver, and that PL8 has been well supported by shareholders such as yourself in the marketplace. So we hope that will continue into the future. Looking to more a market update rather than actual performance, I think one thing that is very clear, it's probably the most certain thing I can say at the moment, is that looking forward, interest rates will remain low for a considerable period of time. Even before COVID struck, Philip Lowe, who's the Governor of the Reserve Bank of Australia, actually said in September last year that it's reasonable to expect an extended period of low interest rates will be required in Australia. And that was before COVID hit. And in March this year, the RBA swiftly cut interest rates by twice to 25 basis points on the 19th of March. And we expect interest rates will stay around 25 basis points, so the official overnight cash rate will stay there for the next 2 to 3 years. And we expect that means that interest rates on term deposits, bank bills and other assets will remain around or very close to, trading between 0 and 1%. And if you take off normal inflation, albeit the inflation in June was a little abnormal, given that childcare is free, but I'm not sure too many pensioners or retirees pay for childcare. But if you look at normalised inflation, people are still probably going backwards in terms of their term deposits or their government bond yields or overnight cash. And the reality is that the falling cash rates have dragged down the yields on all other assets. And the impact of, I suppose, the slowing economy and COVID has also meant that income generated from shares and income generated from even rent on properties has fallen in the last 6 months. You can see on this chart, which is, I haven't always talked about the page numbers, but we're now on slide 15. We've plotted the available market yields on a range of asset classes. The grey line is the official cash rate, and that is now at 25 basis points, which is clearly an historic low for the Australian cash rate. We don't actually expect it to go to 0, but there's a slight chance it might. The term deposit rate in 12-month term deposit rate, which is a time series we get from the RBA, is actually sub 1% now. So it's a margin above cash rate, but it's not that much above it. And a new one that we haven't shown before, but I found this series on the RBA, which is because I think a lot of people are turning to alternate asset classes for income. And this is a series of investment grade credit. So it's BBB rated 3-year bonds, and it's the average yield on those sourced from the RBA. And that has actually recently fallen below 2%. So even when you take on some investment grade credit risk, you're only getting about 1.7% per annum at the moment in terms of return. So that's a pretty low yield for the risk you're taking. We also plot there the yield on the Australian market. This is a gross yield for the S&P in blue, and you can see how that's trailed off in the last sort of 6 months as the impact of COVID has come through. And similarly in black, we've plotted, in this case, not the PL8, but the actual underlying investments of PL8, but it is an after fee number. We've plotted the gross yield that the Plato Australian Shares Income Fund has generated since inception, basically. And you can see that it's, we have excluded those buybacks, the exceptional dividends that occurred in fiscal year 2019. So we've normalized for that. So otherwise it looks silly. But you can see that the yield on that underlying investments has trailed off to around 8% in the, just under 8% in financial year 2020. But it's still substantially higher than the market yield, which is our objective, to generate more income than the market. And again, it's still substantially higher than cash rates. And in fact, we believe that the yields that you're getting on Australian equities, whilst they are lower than normal, still look quite handsome relative to other asset classes, albeit you have the risk of equities, which is quite different to the risk of cash or investment grade credit. So you need to take that into account. Of course, we are looking around for other ways of getting fully franked dividends, and there was a Qantas buyback in 2019 that we did participate in. We were, in fact, looking to participate in a second Qantas buyback, which was announced in the earnings season in February this year. But because of the impact of COVID, Qantas actually withdrew that buyback and, in fact, cancelled paying its dividends. So there was a very quick impact on that of Qantas. But in a normal year, we are looking to participate in buybacks, and we did participate in the Qantas buyback in financial year 2020. We don't expect too many buybacks in the current environment, but there are a couple of companies with excess franking credits. So if they sell assets or do things, there may still be a potential for buybacks, but there are none that have been announced right now. It has been a tough period for many traditional income stocks. We can talk about the banks. I mean, the banks have clearly been challenged in the current environment, and this is a slide that we've been running for a number of years. If you actually look at calendar year 2019, it's very interesting. In the pie chart on the left-hand side of slide 17, the big four banks, Rio and BHP, represented almost half of all the dividends of the market, and the big four banks themselves represented approximately 30% of the income of the Australian market. Now, clearly, the banks are challenged by COVID. They're challenged on a number of fronts. Firstly, in April, APRA came out and basically made a directive to banks to essentially not pay dividends or defer dividends. And Westpac and ANZ and the Bank of Queensland all deferred their dividends, their interim dividends, in April. Subsequently, so in the end of July, as things did improve, APRA have made a second directive to banks and other financial institutions that it regulates, and it has now said that those companies can pay dividends, but they are basically telling the banks that they should pay no more than 50% of their earnings out as dividends. Now, the problem for banks is that, firstly, they've been paying something like 70 to 80% of their earnings out over the last few years. So a payout ratio of 50% means that their dividends will naturally decline. The second problem for the banks is that their earnings have declined due to COVID because they are allowing for the likelihood that there will be bad debts. So the earnings of banks are being hit, and APRA has also said that they should reduce their payout ratios from around 70 to 80% to 50%. The upshot of that is that the banks are paying out something like 50 to 60 to 70% less dividends than they might have done last year, in terms of those that have already reported or paid dividends. So the amount of income that's likely to come from the banks is substantially lower than normal. Telstra has already done a big cut of its dividends. That's a big income stock. And clearly you can see that the banks and Telstra have underperformed the market, really over the last 3 years, which is pretty much since the time that PL8 actually listed, and that is actually the time frame we have on the right-hand chart on slide 17. So it's been a very tough period for traditional income stocks. So I think it's quite pleasing that we've been able to actually outperform the market and deliver more income than the market, despite the fact that many of the traditional income stocks that we do invest in or buy and rotate through have had challenging performance. In fact, if we look at some of the contributors to why we generated more income than the market in the last financial year, We did generate more from some of the banks, or in fact all of the banks, but NAB and Commonwealth Bank are the two top contributors in terms of excess income. But it's interesting that you're starting to see the next three contributors are not banks, but they're actually iron ore miners. So Rio, BHP and Fortescue Metal, we took large holdings in those stocks and rotated through those stocks to capture more income. And in the latest reporting season, those companies all continued to pay pretty strong dividends, albeit BHP did reduce its dividend, but we saw a very substantial increase by the likes of Fortescue. So we're actually finding that there are other areas outside the banks that are still paying some pretty good dividends. In the actual fiscal year, financial year 2020, you still got a pretty good hit from the banks in terms of dividends, but we see that continuing to fall in this coming financial year. In terms of active performance, where did we actually outperform the index? Again, stocks like, iron ore miners, particularly Fortescue Metals, was one of our best stock picks of the year. We actually added 35 basis points by being overweight Fortescue Metals. That stock actually generated a total return in the financial year of nearly 70%. So whilst the market was falling, there were still some very positive lights. Another one was Wesfarmers. Wesfarmers obviously owns Bunnings and, well, maybe not obviously, but owns Bunnings and Officeworks, and they've done very well during the COVID period. Macquarie Bank's also done relatively better. It still had a slight negative return for the year, but it actually beat the market. Another contributor, it's not always the stocks you're overweight that add to performance, but it's also avoiding or dodging the bullets, avoiding the dividend traps. And Centra and some of the other retail landlords have found the going pretty difficult, and we were underweight Centra for much of the year, and it actually didn't pay a final distribution, and that turned out to be a good decision. So that also was a significant contributor. We were overweight Woolworths for most of the year, and that was a strong performer, as was a stock called JB Hi-Fi. I mean, despite the fact that many people have lost their jobs, or they're on JobKeeper and JobSeeker, people are still spending in shops. They're spending on the home office. They're buying computers and computer screens. I did myself actually, and the likes of JB Hi-Fi are actually benefiting. So there's some of the names that we've outperformed in. Another stock we underweighted, and because oil prices have been hit pretty negatively by COVID, was Oil Search, and that also contributed to performance during the financial year. So there are some of the stocks that we've made money on by either being overweight and they went up, or being underweight and they fell. In terms of, we often talk about these dividend traps. In terms of stocks or notable stocks that were dividend traps in financial year 2020, AMP actually cut its dividend to nothing in 2020. It has announced a bit of a special dividend at the moment, and we have actually put our toes back in the water on AMP, but for most of the last 2.5 years, we haven't owned AMP, and it's been a poor performer. Blackmore's also cut its dividend significantly, as did Adelaide Brighton omitted its dividend. So there's a range of stocks there that cut or omitted their dividends during the year, and we didn't hold. And again, that helped us to perform reasonably well. There's no point in buying a dividend-paying stock that doesn't pay dividends. We've used this example before, but the problem with dividend traps, the stocks that cut their dividends, is usually that is associated with a falling share price. And so given we have an objective to beat the market and to generate more income than the market, buying stocks like AMP that cut its dividend to nothing and the share price underperformed is not going to help us meet our objectives. So it's good to avoid those sorts of stocks. Just looking at the reporting season that just passed, so this is sort of post financial year, but sort of looking at this financial year. Yes, it was a pretty poor period. You look at the average dividend change was nearly 30%, which is pretty much in line with our expectation. Although we would note that on a capitalisation weighted basis, when you look at stocks like CSL and BHP, which are very big stocks in the market, they didn't cut their dividends. Or CSL actually increased its dividend, and BHP had a small cut to its dividend. And the market cap weighted, so you look at just by the size of stocks, was actually, the fall was lower than the broad market dividend cut, and that was only 18%. So look, it's not great, and 34 companies cut their dividends to zero. That's not a great period, but we're always focusing on the upside, not the downside. And it's interesting that 22% of companies actually increased their dividends compared to the same time last year, and 11% had flat dividends. And those are the sorts of stocks, and we've highlighted a few with strong dividend increases. I've already mentioned JB Hi-Fi and Wesfarmers, but it's interesting there were some bright spots in gold. Gold prices have continued to remain very strong, and stocks like Evolution and Northern Star increased their dividends fairly substantially. Already mentioned Fortescue, but a smaller iron ore miner, Mineral Resources, actually increases dividends. Magellan, within the financials, has managed to grow its FUM and its profit and increase its dividends. And Horizon is a hauler of commodities, and actually its volumes have kept up, and so its performance and dividends were still quite strong. So, there were some bright spots in an otherwise pretty ordinary period, and our role is to focus on the bright spots and get the income from where the income is generated from, and avoid those dividend traps. Amongst the banks, we think CBA was the standout result. Its profits did fall by 10%, but we think that's a pretty good result. It paid out the absolute maximum dividend it was able to, given the APRA directive. APRA has now directed that banks pay out no more than 50% of their earnings, and CBA paid out, I think, 49.9% of its earnings as a dividend. And so you're still getting some income from the likes of CBA. As a quick summary of the top 20 dividend payers in the market, we highlight this slide 23 we're now on, as the good, the bad, and the ugly of the dividend period. And from my comments, you'll understand that we think the likes of Rio and Fortescue have done very well. Wesfarmers, Woolies, and CSL. Telstra actually maintained its dividend. I know it cut it nearly 50% over the last few years, but it actually maintained its dividend in the latest period. CommBank was the best of a bad bunch in the banks, so it's in the bad category, but not in the ugly. Whereas Westpac didn't pay a dividend at all, so it actually decided to cancel its interim dividend, whilst NAB and ANZ significantly reduced their interim dividends. Even Transurban, a stock that most people would have, a year or so ago, thought that's a very solid stock, it'll never cut its dividends. Well, no one really expected that we'd be not driving to work, not driving at all in Victoria virtually, and that would have quite a negative impact on the tolls that Transurban gets on its toll roads and flow through to its dividends. Macquarie Bank still paid a 50% or paid a dividend 50% lower than last year, but it all came out of the non-bank, non-regulated side of that company. And then some of the other bad stocks, we talked about Centra, but the insurers have taken it pretty tough on their investment earnings, so Suncorp and IAG. And not all miners are going well. South 32 doesn't have iron ore, doesn't have gold, so its commodities aren't quite as good as the others. So quite a mixed bag, but we're focusing on buying stocks in the good category, or at least the higher yielders in the good category, not so much the CSL, although we have a healthy weighting to CSL, to provide our dividend income. And lastly, this is a forecast, and all the caveats should be done from a forecast, but if we look out over the next 12 months, we see overnight cash rates staying around that 25 basis points. I don't think there's any chance that they'll be increased. 10-year bonds are trading below 1% at the moment, so that will be the expected income. So these are the income forecasts. They're not total return forecasts. It is just the forecast of the expected income generated from classes. So overnight cash, 10-year bonds, because the yield is less than 1%, that's the income you get. It's according to the RBA, sub 1%. Similarly, from the RBA, if you bought the company or company credit, BBB rated investment grade credit series, according to the RBA, it was trading at about 1.7% at the 28th of August. So that's sort of yield that you would get. Our forecast for the MSCI World is sub 2%. And our forecast for the Australian equity market and the Australian REIT market is just around 4%, or maybe just a shade above. That is a forecast. That's our best expectation at the moment for the Australian equities. That is a gross yield. But remember that our expectation for the underlying investments of PL8 is that we will get, generate more income than that. Indeed, we are expecting to get up to around 7% in terms of our forecast income on a portfolio, but that is subject to the vagaries of the market. So just summing up on the outlook on slide 25, and then we can move to questions. I think the one thing that we can be pretty certain of is that interest rates will remain quite low, or even lower than they had been for longer. I mean, our expectation is that cash rates will stay where they are for the next 2 to 3 years. And that has dragged down the income levels of all other assets, as has the impacts of COVID. So in a relative sense, we think Australian equity income still looks pretty attractive. And we believe there still is plenty of dividends around if you know where to look. We've mentioned the sort of iron ore miners, gold miners, and some of the consumer discretionary and consumer staple stocks that are doing quite well. At the broad market level, though, we do expect at least a 30% cut in dividends. But as we highlighted in August, about 22% of companies actually increased their dividends. So the impact of COVID is quite fickle. In terms of recovery, look, we think, and my personal view is this will be a fairly slow recovery rather than a V-shaped. Obviously, we've had a second wave in Victoria. We've got a second, sort of level of lockdown there and a slow time period to come out of that. And that, I think, will mean that the recovery will be relatively slow. So we wouldn't be expecting, for instance, bank dividends to bounce back all that quickly, given that sort of scenario. And we do believe in the current environment, the case for active fund management has never been stronger. Avoiding the dividend traps is very important in this sort of environment when so many companies are actually cutting or emitting dividends. So with that, I think we'll seek questions from shareholders.
Great, thanks for that.
Hand back to you, Chris.
Thanks for that presentation, Don. Yes, just a reminder to shareholders, if you do want to ask a question, please type it into the Q&A box at the bottom of your screen. We probably have a couple of minutes for a couple of questions. Don, the first question here from Sarah is, I think it relates to your point about the banks, but maybe more broadly in the market. We had a bonanza in 2019. We had a lean year for dividends in 2020 because of COVID. As the economy recovers, do you expect dividends to sort of get back to the levels they were pre-COVID, or do you think companies' payout ratios might be structurally lower to repair balance sheets?
Well, I think it depends, Sarah, on the time frame. I think they will eventually get back to pre-COVID levels, but I think it will take quite a bit of time. Some companies will need to repair balance sheets, and I mean, some of the most affected companies, we haven't really talked about those, but the likes of Qantas and Flight Centre. To be honest, I think it could be 5 years or more before they pay a dividend, because travel will be impacted for a number of years, particularly international travel. They will have to rebuild their balance sheets. They're basically on save the business mode at the moment, not generating any revenue and minimizing costs. So that's going to be a long slog for those sorts of companies. I think for banks, it will also take a while, because bad debts, I think, are a lagging indicator. But I think generally for many companies, say it's going to be a V-shape. It's not going to be a V-shaped recovery. I think it's going to be a slow grind. But within that, as we've talked about it, there are some companies that are doing very well, and so they will continue to pay, the dividends they're paying now, or increased dividend levels. So that's why I think it'll be a stock pickers market, in terms of there will be some companies that won't pay dividends for 5 years or more, and then there'll be other companies that can increase their dividends from current levels.
And then just one more question from Jake, which is, it might feel like Australian dividends are being cut, and therefore, for those seeking dividend income in Australia, it's been a tougher market. But you, as Plato, also run some global equity income strategies, maybe the question is, give us a feel for how does Australian equity income compare as a generator of income for investors relative to what you're seeing globally?
Well, thanks, Jake, for that question. We have a fairly similar view for global equities that dividends will be cut by around 30% as well. And to some extent, if you actually think about the impact of COVID and how widespread it's been and how bad it's been, Australia's gotten off pretty lightly. We're very concerned about what's happening in Victoria at the moment, the second wave, and there's been for us, a relatively large number of people have passed away, unfortunately. But if you compare Australia to the US or the UK or now Brazil, we have gotten off very lightly in terms of the number of people that have caught COVID and the number of people that have passed away from COVID. So our economy's got through, or our health system's got through pretty well. Yet we actually have got, particularly in Victoria, quite significant levels of lockdown when other companies are opening up. So I think, in a relative sense, given the impact of the disease, we've gotten off pretty lightly, but we still have had pretty significant lockdowns. So, the reality is we expect global dividends to be probably hit as the same level as Australian, but dividend yields globally are lower than in Australia, and they also don't have franking credits. Having said that, even looking broader than just equities, the reality is no asset class has gotten away lightly. We talked before about Centra. The landlords around the world, whether they're retail landlords or residential landlords, are doing it pretty tough as well, because people are, if they're lost their jobs, unable to pay their rent, or if they're unable to open their shops, they're unable to pay their rent, those sorts of things. So the income levels from all asset classes have been lowered because of COVID.
Great. I think that's probably all we have time for, Don. I think we should let shareholders get on with their day. So thank you, Don, for your time, and thank you, shareholders, for listening in. If you do want a replay of this webinar, it will be available on the company's website. So thanks again for your time.
Thanks, Chris, and thanks, shareholders.